Thanks for tuning in to our live weekly Facebook training where we discuss business credit building tips, tactics to get business loans and credit lines, and actionable business growth strategies. We're going live on Facebook starting in 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Going live now with your host, Ty Crandall.
What's up, Facebook? Ty Crandall here, and today we're talking about money. We're talking about a bunch of different alternative ways that you can get money to fund your business. Some we've talked about before, some we never have. So this way, you know the ways to get money for your business: credit lines, loans, credit cards, everything that a lot of your competition doesn't know about. As a matter of fact, probably 60% of this is stuff that most people never even heard of before because it's very unique kind of financing, but it's unique financing that a lot of business owners know. You got to be creative when it comes to financing because a lot of the stuff that most people know about is the stuff that most people can't get. So we're going to be diving in today. We're going to be talking about alternative funding that you should know about for your business. What's up, Michael? Thanks for coming in. So today we're going to be talking about alternative funding sources that you should know about, but your competition probably doesn't know about. So we're going to be diving into, 15, 20 different kind of financing, and we'll talk a little bit about how all of these actually work. So Camilla, welcome. Everybody, thanks for coming in. So this is my favorite funding program, probably one of my 2 or 3 of all time. Okay, so with this program here, this is called Unsecured Business Finance. That's how it works. First of all, you can get up to $150,000 in financing. How much you can get depends on the highest limit of your existing credit card now. So if you have good consumer credit, you need about a 685 FICO score for this, or a guarantor that has one. Timothy, welcome. Thanks for coming in. If you have a good FICO score or somebody else that does, then you can typically get $50,000 to $150,000 even as a startup using only credit to qualify. No doc, no tax returns, you don't need bank statements, no collateral of any kind is needed. Robert, welcome. Thanks for coming in. You don't need any of those type of things to be able to come in and get approved. It's only based on personal credit. Now, you can also use that of a guarantor if your credit's not good. Somebody that can sign for you as the guarantor, or you can use you and a guarantor and get even more money. So you get 0% rates for 6 to 18 months. The credit reports to the business credit reporting agencies. It's one of my favorite funding because you do 2 things. You get up to 150 grand in money, and you build your business credit at exactly the same time. This is a great alternative way to getting vendor credit to start building your business credit. You can get cash credit, Visa cards, MasterCards, to start building your business credit profile and score, but you have to be willing to have a personal credit check and a guarantee for this to work. Now, you also need to have less than 6 inquiries in the last 6 months. Inquiries are a big deal, so you have to limit inquiries on your personal credit report because it can really hinder your ability to get business financing. You also need to have utilization less than 30% and have like some kind of real accounts on your credit report, like revolving accounts that are 2 years old, or a mortgage or not a loan, or something to that effect. So Robert, I said hey to you. Janice, hey, it's been a while. Thanks for coming in. And Christine was just getting ready to message you. Let me know if Trinity's arm is broken. I want to know. I was talking about you last night. I'm sorry I missed you, and I was going to follow up with you today. So please let me know because you've been on my mind today. So unsecured business financing. Love it, guys. It's only based on credit, nothing else, no collateral, no assets needed, no revenue verification, guarantors welcome, get money even as a startup, and build your business credit at the same time. Can't go wrong there. Brian, welcome. Thanks for coming in. Second, business cash advances, okay? So these are also called revenue cash advances, and there's really 2 forms of these. So with this kind of money, with cash, is what they're typically looking at is they're looking at bank account management. Do you manage your bank account responsibly? Now, if you don't know what that means, look back at Facebook. We just did a stream weeks ago about what banks are really looking at when they look at your bank statements. Here's a summary. They want to see that you don't have non-sufficient funds, that you're not overdrawing the account, that you have more money going in than is actually coming out. Okay, they want to see that you have a bunch of deposits, not just a few. But again, most importantly, they want to make sure you're managing your bank account responsibly. Look, the number one thing that lenders and credit issuers care about is, are you going to pay them back? If you are overdrawing your bank account, then how do you have money to pay back a loan if you can't even afford to pay your current bills? That's how a lender's perception is. So they look at your bank account to make sure that you have more money going in, that you're not overdrawing the account. Those are indicators that you could probably afford to pay for the loan. And Christine, good. I'm glad to hear that her arm wasn't broke. I was worried about that. Christine was supposed to be on a webinar, and she actually missed it last night. She was into a serious car accident, so I'm glad everything is okay. Hello, Jesus from Milwaukee. Welcome. Thanks for coming in. And Julia, welcome. Thanks for coming in. So business cash advances, they're looking at business bank account management. Now, typically, sources are going to want you to be in business 1 year or more. If you go to creditsuite.com/fundbox, there's a source that will start to approve you when you're about 3 to 6 months in if you have good bank account management. And they won't even ask for income docs. They won't even ask for bank statements. They'll automatically get your information from your bank, so it saves you time and energy. PayPal and Square, get accounts set up with them early in your business. They'll give you money 3 to 6 months into you being in business, and they'll give you 30% of what your deposits are with them. So very high approval amount and very low fee. Now with most of these lenders, they'll give you 10 to 12% of whatever your annual revenue is in a loan. That means if you have $200,000 in annual revenue, they'll give you 10 to 12% of that, which is about $20,000, $25,000 in financing. So they're only going to look at your bank account. They don't really care about credit. They don't care about collateral. We've got sources that don't look at credit at all. We've got sources that go as low as 500. So credit's not an issue here. All you need is good bank account management, about $10,000 a month in revenue going through your business bank account, and 1 year in business. Again, if you have less than 10 grand, PayPal, Square, they still may help you. Places like Fundbox may give you a small one as well. If you've been in business less than a year, PayPal, Fundbox, Square, they'll all work with you less than a year. There's some other sources out there that will help you if you've been in business about 6 months. So business cash advances, merchant cash advances. We talked about everything you need to know here. One other thing you need to know, the rates can get pretty expensive depending on risk. If you've been in business a longer period of time, if you have better credit, if you have better bank account management, those things can help bring down your rates. These things get a bad rap of being expensive, but the reality is we see clients that go in at 8% rates on these, very equivalent to SBA. But high risk borrowers can pay 30, 40, 60% interest on these things. High risk is somebody shorter term in business, not great bank account management, credit issues. Just keep in mind, the higher risk you are, the more interest you'll pay on any program. This program, you can get money in about 72 hours, about 3 days, sometimes faster. And all you're going to typically need for approval is just your bank accounts, your bank statements, about 6 months of bank statements, and you're going to need merchant statements. Again, some sources we work with won't even ask for those. They'll get them electronically from you. So we're going to go over a bunch of options today. But if you want any information on them, feel free to give us a call. We'll talk to you a little bit more about you'll qualify for. Michael says, are there programs that go off strictly PayPal statements and not bank statements? Yes. PayPal has loans that they do just based on that. There's no other lenders that will go only based on PayPal. Great questions, Michael, by the way. There's no other lenders that will look just to PayPal deposits, but PayPal will. PayPal, and you want to go with PayPal. Here's why. A normal lender will only give you 10 to 12% of your deposits. PayPal gives you 30% of your deposits. So go directly to PayPal. They can give you up to 30% of those deposits, and in a lot of cases, they only charge one flat fee, like $500 for the whole loan. So it's a great way to go. Securities-based line of credit. So these are using stocks and bonds as collateral for financing, where you can get credit lines and loans with rates under, this should be under, not over, 5%. And you can get about 90% of the value of your stocks and bonds. Now, there's something similar here with 401k financing, where you can get 100% of the value of the 401k, rates less than 5%, and you're still earning interest off your investments here. So here's how these work, okay? Here's how both of these work. You have stocks, you have bonds, you have 401ks, you have IRAs. You use those as collateral. You still keep them in place. You still earn the interest. You still earn the return. They only take them if you default. The nice thing about these things is that you can get interest rates of less than 5%. You can choose between a loan and a credit line. And again, it doesn't even affect your life in case you default. Then they take the asset. So this is good for you, but it's really good for investors as well. 75% of business owners get money from from family and friends. So here's the thing. It's easier for you to use a stock from a family friend as collateral where they don't have to do anything with their money unless you default than it is for them to give you physical cash. Let's say I'm going to my grandpa and I want him to invest in the business and I need $50,000. Well, if I go to grandpa and ask him for $50,000 in cash, that's a problem. If I take his cash, he's less that 50 grand. He doesn't have that 50 grand in cash now. He's not earning interest on that 50 grand in cash. He's out the 50 grand. And if I default and never pay him back, he lost the money. But if grandpa used his stocks as collateral, nothing changes. He's not out the 50 grand. He still earns the interest on the 50 grand. The only time that he would have a problem is if you defaulted on the money. So it's a much easier and lower risk for them to invest in your business if they're using assets like stocks, bonds, 401ks, or IRAs as collateral to help you get the money than just giving you the money. It's going to be easier for you to get the money from them, and it's less risk and less of a hindrance on them to use assets to help you get the money instead of giving you the physical cash. So I'm telling you these things because not only do maybe you have stocks, bonds, 401k, or IRA, but maybe people around you do, family members, friends, potential investors, people that want to invest in your business, and they can use those as well to help you. Kevin, welcome. Thanks for coming in, man. I'm excited to be here. We've been going back on Facebook today. It's good seeing you jumping back into the game. So account receivable financing, also called AR financing. With this, you're using outstanding account receivables for financing. I'll talk to you a little bit more about that. You can get up to 90% financing of the receivables and get your money in less than 24 hours with rates as low as 1.33%. Here it is. AR financing is the cheapest form of financing that exists, period. You can get rates as low as 1.33% and 90% against your account receivables. What's this all about? An account receivable is where a customer is paying you what is owed through payments. So here's an example. If you enroll with us to build your business credit, we let you make payments over 7 months. That's an account receivable. If you choose payments, you enrolled at a certain amount of money. We're letting you pay over 7 months. The fact that you're paying that money over 7 months, that you owe that money, is an account receivable. Now here's what you need to know about AR financing. Account receivables are the most valuable asset a business has. They are the number one asset used for SBA loans. They're the number one asset that's used for businesses to be acquired. Meaning people that want to buy your business care a lot about account receivables because that's how they can get the money they need to buy your business, to fund your business. So account receivables are extremely important. They radically improve the value of your business because if you have them, you have an asset that helps somebody get money to borrow money to buy your business. It also helps you borrow money to get for your business. Places like SBA loans, using account receivables, the number one form of collateral, will help you. But also helping your customers pay over 7, 9, 10 months, 6 months, that helps you attract more customers because you're making it more financially easier for them to enroll with you. And you're acquiring an asset that helps you get money. Once you start accepting account receivables, AR lenders at 1.33%, as low as that, will actually lend you that money without you having to wait. So here's how it works. Let's say you have $100,000 in account receivables. The lender will give you 90 of the 100 tomorrow, the next day. You don't need to wait weeks or months. So in my example, instead of us waiting 7 months to get paid, we get 90% of our money the next day. You think that helps? You think it helps to ease cash flow when you're getting all that money the next day versus 4 months down the road? Big time. So then the 10% that's outstanding minus the lender's fee is delivered to you once the invoice is actually paid. So instead of you waiting months to get paid, you get 90% of your money right away. The rest of it comes later down the road once the invoice is paid. Serious ease of cash flow. It really helps you get access to more cash flow, helps you offer payments to your customers, and gives you huge assets that helps you obtain financing and become more lendable to get things like SBA loans as well. So AR financing, a great way to go. Now, also there is purchase order financing that can help you get the money you need to purchase, to get purchase orders financed as well. House flipper financing. This is great for my real estate investors on the call. So this is using real estate as collateral where you can get 100% of the money you need to buy and rehab residential properties, or what they say up to 65% of after repair value. Rates of about 8% plus, 660 FICO need approval. So you want to flip homes. Let's talk about it. There's several different options that could work for you. The first option I told you about, unsecured business financing, is one of the best. You could take the cash out of those credit lines, get up to 150 grand to buy your first property. Great way to go. You could build your business credit and get Visa cards, MasterCards, cash out those and use them to buy property as well. A lot of options. House reseller is working for somebody that has some kind of experience flipping homes. You need to have about 3 home flips in the last few years under your belt. You need average credit, 650 or 660 score or higher, and you need money in the bank that you're willing to put into an escrow account. In our clients, for example, typically our clients do not get this loan right away. They get unsecured business financing, 401k financing, one of these other options we talked about to buy their first few properties. They flip them. They now have a history. Then they just start using this for all their purchases because the lender will give you 100% of the money you need to buy the home and fix it up to rehab and repair the home to turn around and sell it. So it works great if you're focusing on fix and flips, but you need some experience to get into it. So use some of these other kind of financing to do your first few flips. Then you can come in and use house reseller program. So I mentioned something that I think can cause a discrepancy, so I always like to explain it. I said somebody can get 100% of the money they need to buy in rehab. I also said that they can only get 65% of after repair value. So what's being said here is the lender saying they want you to buy the house right, and if you bought the house right, then you bought it cheap enough to get a loan, fix it up, and still be under 65% of what that property is going to be worth when it's all fixed up. But if you didn't buy it right, well then maybe you can't get 100% of the money, but you can get close. So how much money you get depends on how well you're buying the house, right? You can get up to 100% of the money you need to buy and rehab the house as long as you don't exceed 65% after repair value. So that means you got to buy the house right, or you're going to have to put more money into it. The better off you buy the house, the less money you actually need. So a great program for real estate flippers to have some kind of experience to be able to get financing here. So let's talk a little bit about business credit as well. Vendor credit. Now this is trade credit, okay? These are vendors. These are people that will basically give you credit on many of your typical purchases, and they report that credit to the business reporting agencies, okay? So they'll approve you even if you have no credit, and you're gonna wanna get about 5 of these accounts to move to the next step, and you're also going to be sometimes for trade references. 80, welcome. 80 Jewel, appreciate you coming in. So look, when you're starting to build business credit, there's 2 initial ways to do it. You can do it using what's called vendor credit or trade credit. We call this the vendor credit tier. The vendor credit tier is when you first get accounts that don't look at your personal credit, don't have a personal guarantee, that help you build business credit. Uline, Quill, Gimplers, Granger, Wells Fargo Secure credit card, they all fit into that category, okay? Those are vendors. Now, vendors will give you credit when you have none, and they report it to the reporting agencies. They help you start your business credit report and score. The second way to build initial business credit, I already told you about. It's unsecured business financing. It's where you get up to 150 grand at 0% rates. The problem is that only works for people with credit issues, or that with good credit. So vendors work even if you have credit issues, or you don't want to give a guarantee, or don't want to give a credit check on your initial accounts. Unsecured business financing, the credit lines work better if you have good credit or have a good credit guarantor. We see a lot of people that have bad credit. They have a guarantor that has good credit. They use a guarantor to get cash and build their initial business credit. So vendor credit is a great way to start building business credit, especially if you're not going with the unsecured business financing option. Now, once you've got about 5 of these accounts, then you move to the retail credit tier, okay? This is a tier where you're gonna need to get about 10 accounts to get to the next step, 10 to 14, and you're trying to leave your social security number off the application and get this without a credit check or without a key. Look, as of 2018, things have changed. Lenders now have a requirement, banks have a requirement from the federal government to verify you as a business owner's date of birth and social security number to verify you're a real person. Only for money laundering. That's it. They don't care about personal guarantees and credit checks. All the government cares about is money laundering. And to be honest with you, we're way behind on this. Many other countries have already adopted this many years ago. When it comes to this stuff with money laundering, for some reason, the United States seems to be the last to adopt. But we did adopt in 2018. So what this means is it means when you apply for vendors or retailers or stores that are not backed by banks, no big deal. Nothing changes. But if you're applying for a credit card through a major bank or a place like Office Depot and Staples that are backed by Citi, well, then what happens is Citi's a bank. Citi has to comply with that requirement. They may ask for your social only for verification purposes. If they do that, you need to make sure that they know they do not have your authority to pull your personal credit or a guarantee. That way they know that you're only able to get that, or you're only supplying that for the verification for the government purposes, and you can still get credit all day, every day, as we see, without the personal guarantee and credit check. Leave the social blank when you can. When you can't, clarify that you're not giving authority for a personal credit check. So what happens here is once you have 5 accounts reporting on your business credit reports, then you have a profile, then you have a score, then you have trade lines. Then you can start to move to an Amazon, a Staples, a Home Depot, a Dell, an Apple, retailers. Then they start to give you credit based on your established business credit profile and score. And since you already have an established business credit profile and score, they can get you this money without the guarantee, without the credit check. Your business can stand on its own. The more of this credit you get, the better your business can stand on its own, the less you need a guarantee. So you've got to build this business credit. Vendor credit will get you started. Store credit, retail credit will get you to the next step. Then you can really, when you have about 5 to 8 of these accounts, you can get fleet credit. This is for vehicles, and for fuel, for repairs, for maintenance, etc. And when you have about 14 accounts, you can get cash credit, Visa cards, MasterCards, American Express. You can even get auto vehicle. So there's a few tiers here. There's the vendor credit tier, which we talked about, the retail credit tier. There's the fleet credit tier. What's fleet credit? You work in an office? Doesn't matter to you. Doesn't matter to me. I don't have any fleet credit cards. I don't need them. But I have clients like Christine, who's on with us today, that's a truck driver. She's got a ton of fleet credit, like hundreds and hundreds and hundreds of thousands of fleet credit, because she has a fleet of trucks. She needs to put fuel in them. She needs to do repairs. She needs to do maintenance. So when you have a fleet of vehicles, fleet credit is a saving grace. Then when you have about 14 accounts, you move to the final tier, which is called cash credit tier. The cash credit tier is Visa cards, it's MasterCards, it's American Express, it's Chase Inc., it's PNC Bank, for example, it's Amex. They will give you these cards without a guarantee and without a credit check. But you've got to have 14 accounts reporting. You need one credit card with a $10,000 limit on your business credit reports to do it. So you can't just get business credit just to get it and have 5 accounts to move to the next step. You need to actively be using the credit. Your credit reports don't show limits, they show the recent amount of credit you're using. So credit issuers are going to look at how much you're using to determine how much you should be approved. If you're not using your credit very much and your credit report shows that every one of your credit issuers you spent less than $100, then nobody's going to give you a $10,000 limit. So get credit with the places you actually need it and are going to use it. Use the credit, put balances on there, pay it off, and those higher balances that they see that you're actually using the credit is what will get you future approvals that are very high. This is how our clients get 50, even 100. We've got $300,000 credit lines with one source. Individual credit sources giving you $150,000 to $300,000 credit lines. How do you do it? You prove that you're using a lot of credit, and then they want to give you the line because they see that you're responsibly spending money based on your credit profile and score, and they also see that you're actually using the credit, so they want you to start working with them, and that means they'll give you other future higher approvals. I have 22 accounts and still can't figure out how to get cash for the business. Well, the question becomes, Michael, the first question becomes, what's your highest limit with those accounts? Remember, you've got to have at least 14 accounts reporting and a limit of 10,000 or higher. If you don't have both of those, you're not going to get approved for that cash credit. Okay, so business credit lines, you can borrow up to $1 million. Okay, average credit $620, $650, but they're going to want tax returns that show some kind of profit. Let me tell you one of the best kept secrets that lenders don't tell business owners but should. If you show some profit or no profit, it is a night and day difference in our world in the business funding space. Businesses that have some kind of profit and don't show a loss can get low interest rate term loans and low interest rate lines of credit all day. The problem is that when you show a loss, even if it's a loss of $1, then you can't get those same credit lines and loans. We call this graduation. We take people from the loans they can get, we graduate them into low interest, long-term loans and credit lines, then we graduate them to the final stage of SBA loans. Here's why people don't typically self-graduate into term loans and lines of credit. They listen to their accountants. which is always a bad idea for anything other than accounting advice. And the accountants say, write off everything, spend as much as you can at the end of the year. You can pay as little as taxes as possible. What your accountant won't tell you is that when you show little to no profit, no lenders want to lend you money. Why would they want to lend your business money if you lose money? Okay, it makes a big deal. Okay, so with that being said, you need to make sure that you come in and that you do this. You need to make sure that you've come in and that you've set your business up the right way and that you're showing actual profits on your tax returns. The profits is what opens up this second middle tier of funding. You have the low level tier, all the financing we're talking about here. Then you have the middle level tier, low level interest rate credit lines, low interest rate credit lines, low interest long-term loans. Okay, needs average credit, needs tax returns with profits. Then you have the final stage, SBA loans, need collateral, cash flow, and credit to get approved. So if you want the long-term low-rate loans, work on fixing your consumer credit. It factors in. Also, show profits on your tax returns. It becomes extremely important. And Michael says, with business funding up to $1 million, do lenders ask for you to fill out a 4506T form? Sometimes they will, sometimes they won't. But on any loan in the United States, they're going to want your Social Security because they need to verify who you are as an individual. So they're always going to ask for your social in the United States. You can't even get loans unless you have a social here in the United States. Sometimes they ask for a 4506T and sometimes they don't. What that does, Michael, is that's a form they can send to the IRS to verify what you're actually telling them, and including even income. So 4506T is what they're going to send to the IRS to verify what you're reporting. Sometimes they're always going to need your social, and sometimes they are going to go through that additional IRS check to verify what you're claiming for revenue, etc. as well. Crowdfunding, Kickstarter, Indiegogo, etc. Okay, if you have a good idea and the crowd likes it, then they may donate. Okay, so again, this money doesn't have to be paid back. It just relies on a good product or a pitch to actually succeed. So here's what it comes down to. What it comes down to is crowdfunding only works if you have something unique and different. If you're a real estate investor, nobody's going to give you money on crowdfunding. I don't want to say nobody, but not enough for it to make any impact. But if you created something that's really cool, really novel, really unique, then it could work. I always use the same example because I love this invention. It was something that sits at the top of your stairs that you open the container and it's a whole slide that turns your whole stairs into a big slide. Well, that's awesome. And that's fun. It's cool. It's unique. It's the kind of thing you'd share with your friends. You show people. That's the kind of stuff that makes this work. Crowdfunding only works if you have two characteristics. One, you have to line up your own investors first. Kickstarter, Indiegogo, they have to see a bunch of people are investing on their own before they'll see it as viral worthy to be able to push it out to the database. Two, you've got to rely on your own network to share this, meaning that it's just kind of like Facebook. If you have a Facebook company page, you have maybe hundreds or thousands of people that like you, but Facebook only shows your actual content to a small fraction. If that small fraction of people likes it, comments, engages, Facebook shows it to more people. It's the same as Indiegogo and Kickstarter. If they see a campaign that a lot of people are donating to, and that a lot of people are hitting that landing page of that campaign, they see it's a hot campaign, and they start showing it to more people. If more people start to visit the site, more people donate, then they realize it's something viral worthy, and they show it to their whole database, and that's what gets it to go viral. But the whole thing is done based on your audience sharing it, based on you lining up donors to begin with. You have to start it. So some of my friends have one of the best ideas to do this on social media. They have a network of 20 to 50 of them, and when they have content they really want to get out in the space, they go to their network, and their network instantly likes and comments on that post. That gives Facebook post an instant 20 to 50 likes or comments. Facebook sees it as hot and shows it to more people. So that's exactly what's going on here. You need to line up the donors first. You need to know that your ability to share will determine whether or not you're going to get crowdfunding or not. So a lot of things we talked about here. Credit lines that work for you as a startup. Merchant cash advances, business cash advances, securities-based financing, 401k, account receivable purchase order. We talked about getting money to flip homes. We talked about 4 different tiers of building your business credit. We've talked about getting credit lines. We've talked about getting crowdfunding as well. Some others not to forget about are angel investors. We just did a great webinar on angel investors you can find on our YouTube channel. That's another great source. Venture capital might be if you're a little bit further established as well. And we just did a Facebook Live on how to get money through every stage of your business from startup to expansion. I think that can help you as well. So a couple things you might want to do right now. Give us a ring if you want to talk more about funding, or if you don't like to talk to people, because we don't like that in today's day of age. Go to creditsuite.com/get funding. You can find out really quickly all the money that you can qualify by going there or giving us a call. And don't forget to grab your free guide at creditsuite.com/Facebook that will map out the exact steps to build credit. Now you can also go to facebook.com/credit suite, go to our messenger, type in the letters EIN, little secret most people don't know about. And if you do that, you'll get a free guide there, and we'll notify you every week when we go live here on Facebook. We don't send you a bunch of spammy crap through Messenger. We rarely send anything through Messenger, but we will send you a reminder when we're getting ready to go live. So a lot of cool things to come. Let me tell you about next Wednesday. So next Wednesday, we're going to be diving in and talking about how the reporting agencies get your information. This is a good one. And it's one of the ones that surprise a lot of people. So what we're going to be talking about is how the actual reporting agencies get your data. We're going to talk about all the different places they get your data. Look, why is this important? Did you know that stuff on your Yelp search can end up on your business credit profile? Did you know stuff on your Facebook page can end up on your business credit profile? You should. That's what we're talking about next Wednesday at 4 o'clock Eastern. Where these reporting agencies get their data, and here's why it's important. If you know the data they're getting and where they're getting it from, you can control those things. And if you can control those things, you control what goes on your report, and you're controlling the perception others have about you. It's all about knowing how this thing works and controlling it. The people that know how the credit system works and know how to control it have a huge advantage over those that don't. I'm going to bring you into the Insider Circle next Wednesday at 4 o'clock Eastern, and I'm going to talk to you about exactly how this works, where they get their data, how they're using the data, and what you need to know so you can control the quality of the data the reporting agencies are getting, so lenders and credit issuers, so the Small Business Financial Exchange, LexisNexis, all these guys that are behind the scenes giving the data are giving the data you want to give to the reporting agencies, who then give the data you want to give to the lenders and credit issuers. Next Wednesday at 4 o'clock Eastern, we'll be there. So make sure you go to facebook.com/credit suite, type in EIN into Messenger, get invited to our stream next week, and I'll see you next Wednesday at 4 o'clock Eastern here on Facebook. Thanks, everybody. Have a great day.
Please like and subscribe to Get Credit Suite on Facebook for more live Facebook weekly training on getting money to grow your business and other business growth strategies. And don't forget to grab your free 4-step business credit building guide at creditsuite.com/Facebook.